So now the new budget has been handed down, and we've had some significant tax legislation that is in proposal to potentially be enacted. So what's important today is we wanted to run through some of these proposals and explain how they may provide some level of impact when considering future investments, property, around things like tax and capital gains. It's important to understand that all of these current federal budget proposals are just that. They're in proposal and none of them have yet been enacted. So they still have to go through the parliamentary system. So we're going to kick off with the negative gearing changes that have been proposed. So what is negative gearing? So negative gearing is the ability to claim back tax losses on investment property or on any investments where you've got a gearing strategy attached to that investment. And effectively, the losses that are made from that particular investment, you're able to claim that in your income tax return. So it can actually offset or it can actually provide a deduction against your existing taxable income. What they're doing is now that they're zoning that to your specific investment itself, so you can only claim the expenses that relate to that investment against the income from that investment, unless you meet certain criteria. So the proposal at the moment has basically grandfathered and put a provision in that anyone who had entered into a property arrangement as of budget night or has existing properties as of budget night or prior are no longer subject to this regime and therefore can continue to negative gear into perpetuity. For those who are now considering to buy investment properties, there is kind of two schools of thought. One is that if you're buying a new build and you're adding to housing supply, then effectively you can continue to benefit from this negative gearing regime into perpetuity, in comparison to if you're buying a second-hand property, then negative gearing changes will kind of take effect from 1st July 2027, and you will no longer be able to have the benefits from this strategy. Why is this important? Well, look, negative gearing is a form of a benefit or kind of cost relief, as you may want to put it, in relation to holding investment assets. What that means is that if, for example, you're buying a property and you've got a $30,000 loss every year on that property, which is being funded from your cash flow, it gives you the ability to claim that $30,000 against your tax, so it lowers the overall impact of holding that property. It basically allows you to have a lower holding cost on that asset. That's very important because effectively, at the end of the day, you're trying to make money by buying investment properties. So effectively, as that property grows in value over time, the appreciation is what you want to take off the table, and you want to be able to utilize that for other objectives. If there is a high level of holding cost, then effectively that cost does impact the overall returns that you get from this particular asset and diminishes that. The other thing that's also important to understand is that when you are selecting investments, you're obviously selecting them on the merits of the assets. Now, this may change the way people look at investments altogether and property investments in general. Negative gearing, however, is only isolated to property classed assets. So effectively, if you're doing debt recycling strategies, utilizing shares or other forms of investments, then it does not apply or change what you can and can't do in that particular space. So it's important to understand it is isolated to property. What's also important to understand is that it takes effect from 1st July 27, and there are certain properties that are exempt and others that are not. Another critical change that has occurred in the budget, which is again under proposal, is the capital gains discount changes. Now, what's important to understand here is that the capital gains discount that is currently in effect is the 50% discount. And this discount allows you basically to be able to significantly discount the amount you would have to include within your tax return when you are selling out of an investment asset. So if you take it, for example, an investment property, which you bought for $500,000, grows to about $1 million, so you've made $500,000 in gains. Under the current regime, you can basically have a 50% discount on that asset, so $250,000 would be included within your tax return as taxable income. What they're changing is they're wanting to move this towards the indexation method. This was a previously used system, and the indexation system will basically mean that the asset that you currently have will be indexed, the purchase price will be indexed until the date of sale, and effectively increase the cost base of the asset, then of course also reducing the overall capital gains that would be applied. Which one would benefit you more? Well, it just depends on, I guess, it just depends on which one's going to provide you with more CGT relief. It has been shown that in the past, one can be better than the other, but it does depend on the growth of the asset, the time the asset is also held. One thing that's important to understand is that this change is going to take effect from 1st July 2027. And so effectively what will happen from here is that if you have pre-existing assets or if you're buying new assets between now and 1st July 2027, you can still continue to have the benefit of the 50% discount. But onwards from 1st July 2027, the indexation method will apply across all assets except for new builds, which can continue to benefit from that 50% CGT discount. So this is going to be a tricky one, we feel, logistically to apply, because effectively up to 1st July 2027, you will have the relief of the 50% discount, but then going forward, the indexation method. So one thing that's important that may need to be considered is valuations as of 1st July 2027 on property assets, to ensure you know what it is worth at that point and then which method will be applied going forward. Now, we don't have a lot of clarity as to the exact mechanics of this, and we are still waiting for that. So it's something that we would probably have to wait and see what kind of method would be considered, given the type of timeline this legislation is working within. One thing also that is important to understand is that with the CGT discount method, it does not impact widely held trusts, or it does not impact self-managed super funds. So within your superannuation landscape, the same CGT mechanics continue to apply.
One of these small business incentives that was announced last night in the federal budget is the instant asset write-off. So the government has permanently allowed small business owners to write off assets that are valued $20,000 and under. Essentially, this allows the business to claim that expense upfront and immediately, allowing for improved cash flow and essentially having to get that tax benefit upfront. If you have an asset that's valued more than $20,000, it can be placed into a small business pool, which will allow you to claim 15% in the first year and 30% the year after.
We're also seeing changes that are occurring within the trust landscape. So at the moment, trusts are basically look-through structures which will provide income distributions to beneficiaries, and then the beneficiaries pay tax at their respective marginal tax rate, whether these are corporate beneficiaries or whether these are individuals. What's important to understand is now they're creating a flat tax of 30% on trusts. And unfortunately, we don't have all the nuanced details around this, but what they are saying is that there will be a non-refundable tax credit that will apply when this distribution is passed on after the trust has paid tax at 30% to the respective beneficiaries. And won't apply, and the non-refundable credit will not apply to corporate beneficiaries. So again, a very important element for those who are using bucket companies as a strategy for tax minimization. These changes take effect from 1st July 2028, and of course may mean major movements or changes to various individual strategies. And it's so important to have a chat with your respective accountant and financial advisor to understand the impact of this if and when it does pass legislation.
Now, starting from July 2027, a permanent tax offset has been announced. It's called the Working Australian Tax Offset of $250, which will commence from 2027 and will be permanent, $250 that goes towards your own income. It could be used against your salary or even business income. Now, one of the most important bits to understand is now your effective tax-free threshold has just gone up in that financial year. You can actually earn more and have the $250 offsetting your income. The Working Australian Tax Offset doesn't come into effect until the 27-28 financial year. Until then, a $1,000 instant tax deduction for work-related expenses this coming financial year from 2026 to 2027.